What's up, everyone? It's Scotty with MoneyVest. Let's talk about Inmode. And Inmode was down a little bit over 19, almost 20% here on the day. So definitely selling off quite aggressively. And of course, that happened on the back of lowering their guidance for fiscal year 2023. And for that reason, we have kind of witnessed this over and over and over again from this company. And if you've been tracking Inmode for the last 3 years, as I have, this has been an ongoing thing, right? This has been an ongoing trend where Inmode comes in with a lower guidance, they kind of under-promise, and then they over-deliver when the earnings actually come out. So we've seen this story before, and I want to go over the fundamentals in this video for the company and kind of show you where exactly it is from a fundamental perspective, and where that good deal area kind of sits for the company. So as always, if you enjoy this video and find it helpful, make sure that you drop a like and don't forget to subscribe to the channel. And of course, link to our Discord and Patreon is going to be down below if you're interested in joining, and of course getting access to all the buy and sell alerts, options alerts, trade ideas, and all the members only private videos. Everything's going to be available. Again, I opened up a couple more spots if you want to join and be a part of our MoneyVest community. We actually have an Inmode stock report coming out this week. Yeah, that's true. So on Sunday, I'm going to be posting a 6 or 7 page report on Inmode, and that's going to go over the entire stock analysis, including the fundamentals. We're going to do a SWOT analysis as well, and then look at the fundamental quantitative analysis with respect to the fair value, intrinsic value, all that stuff. Now, in this video, I will highlight some of the risks related to Inmode's future, and then we'll jump into the fundamental analysis for this company. So the main reason for the stock selling off here obviously was a reduced revenue guidance, right? So the company came out and pretty much mentioned that they now expect full year 2023 revenues to be in the range of $500 and $510 million. That's down from the previous estimates of $530 and $540 million. So that was a decrease of about $30 million decrease in overall revenue expectations on the low end and on the high end. And Inmode cited factors including the current economic slowdown, slower purchasing decisions due to slower aesthetic activity during the summer, and constraints in the financing of medical equipment as a result of higher interest rates and a tighter leasing approval standards and bottlenecks in loan processing, all of which have impacted Inmode's platform sales activity globally. Now, one of the things that we have to understand is that Inmode very much deals in a discretionary sector, right? I mean, a lot of the folks, a lot of the patients that are actually going through these procedures are discretionary spendings, right? These are cosmetic procedures that are not necessities, right, so to speak, from insurance perspective. And as a result, if interest rates are higher, if cost of borrowing is higher, right, that overall puts a significant impact on the wallets of the patients that may not want to spend all that money given how high the interest rates are. And then if you look at the other side of the equation, right? The physicians, the surgeons, the doctor that are actually buying these equipment, they're financing these equipments as well because they're buying them in bulk. They're buying them a lot. And as interest rates are higher, once again, that creates lower demand considering that rates are higher at the moment. And that makes sense because if they're not getting as much volume, as much activity of patients, given the higher interest rates, it doesn't make sense for them to, shell out all that capital to buy all these machines, given how high the rates are, and they're not getting as much volume of patients in this higher interest rate environment in the first place. So, that higher interest rates in general affects Inmode because it's a discretionary spend. Number two, I also want to mention that the market that they operate in from a niche perspective is not that high, right? I mean, it's not like they're working with $100 billion market or $200 billion market. I did some research and I found that there's a couple different reports that suggested that Inmode operates in about $20 to $30 billion market, right? So the TAM sizing and the growth potential for Inmode, according to Needham & Company, as of September 2023, so as of last month, they estimated that Inmode is working with a market of $20 billion. And the report notes that the TAM is growing rapidly, and driven by factors such as the increasing popularity of minimally invasive cosmetic procedures, the aging population, and the rising demand for body image enhancement. Cowen as of August 2023, reported estimated TAM for Inmode's products to be around $30 billion also. The report notes that the TAM is fragmented with many different players offering competing products and services. And however, Inmode is well positioned to capitalize on this growing market given its strong brand recognition, the innovative products, and of course its sales and marketing reach, and the lower taxes and the manufacturing process and the higher margins makes Inmode kind of stand out from a fundamental perspective. And finally, we did have another report from Oppenheimer in July of 2023 estimating the TAM for Inmode to be at roughly $40 billion. We got 20, 30, and $40 billion is kind of like those numbers. And again, they also mentioned the TAM is being driven by increasing popularity of minimally invasive cosmetic procedures, the aging population, so demand is growing. And Oppenheimer is bullish on Inmode's long-term prospects, and the firm believes the company is well positioned to maintain its leadership position in the minimally invasive aesthetic market. So I wanted to go over the market because there's been this huge overhang with respect to the risk for the company that the company long term doesn't have revenue drivers, right? Once the sale has been made, there's no way for them to generate revenue, right? There's no recurring revenue model. And I think that's a fair assessment. But we're not there yet, right? The market's not saturated to a point where Inmode has, already kind of capped out on its opportunity and there's no more upside potential. I think a lot of the revenue sort of reduction and the guidance lower is on the back of macros. I think they've already sent out a release or a press suggesting that the current geopolitical tensions in Israel are not going to affect their manufacturing all that much, which is actually good because that was one of the reasons as to why I was a little bit more hesitant in kind of going into Inmode in the first place. I did start a position a couple of days ago, a very, very small position, and we'll be looking at adding more here, just considering how good the fundamentals end up being. Like, if you take a look at the overall numbers here, I mean, this is one of the most well-run companies out there, right? If you take a look at the revenues, and again, I'm not making these stuff up, right? So you look at on an annual basis, revenue's gone from 53 million to 450 million. And if they end up doing 520 million in 2023, we're looking at 520 divided by 454. That's a 14.5% growth on a year-over-year basis, right? 14.5% growth in a year where interest rates are higher for longer, and they have been so extremely high. So the business wasn't that much affected. Yes, they did lower their guidance by a little bit. Yes, they did lower it by 30 million. But even after that guidance cut and the higher interest rates, they're able to grow at 14.5%. If you take a look at profits here, so profit net income, 22 million, growing to 161 million. And we're looking at, 35, close to 40% margin on 520 million. So if you do that multiplications, we're going to do 40, well, let's do 38. That's almost $200 million in net income, right? That's up from 161. So 200 divided by 161, we're looking at a 24% growth in net income, right? So you've got a company that's growing revenues by 14.5%, 15%. You've got a company that's growing net income or expected to grow net income by about almost 24%. And the stock ends up down 20%. Why? Because of the guidance cut, because of those macro factors. Now, if you come over to the balance sheet, I mean, it's just absolutely phenomenal. Now, I've got one more bone to pick with Inmode. And I think that is, what are you doing with all that cash, right? I mean, if you take a look at how much cash they have, if I simply look at the cash and the total liabilities, we're not even going over debt. We're not even going over current liabilities or anything. We're going over all liabilities. Every single liability that's on the balance sheet for Inmode is at 90 million. 90 million versus cash sitting at over $500 million, right? So that is an excellent ratio. Like, this is, the bankruptcy risk is so low for this company because they've got, I don't know, like 7-8 times more cash than all liabilities. So even if they pay down all liabilities tomorrow, they'll still have over $400 million of cash left over on their balance sheet, right? But then the bone to pick I have with Inmode is that, what are you doing with that cash? Either acquire or buy back own shares or pay out a dividend, right? Do something with that cash because right now it's just sitting there. It's not doing anything. It's grown. In the last couple of years, you'll notice it's gone from 415 to now over 547 million. Every single quarter, they're generating more cash on the balance sheet. That's phenomenal, while keeping the debt levels the same as before, which is, just unheard of. I mean, debt levels have gone down from fourth quarter 22 when they were at 90 million. They've gone down to 67, 68 million now. and the cash is even higher at 629 million actually. So I was giving you guys the annual numbers. If you come over to the quarterly, the most recent quarter, actually, it's even better. $629 million in cash and just under 68 million. So 10 times more cash than all liabilities. So the company needs to do something. I mean, considering the price is so low, and we'll get to the valuation in just a minute, but in my opinion, I think there's one of three things a company needs to do. Number one, either buy back shares. Number two, either issue a dividend, if you can, considering how much cash they have. Or number three, start looking at opportunities to acquire and expand your TAM. Because 20, 30, 40 billion dollars, yes, that is a reasonable TAM for a company that's doing $500 million in sales, so they have the potential to grow. It's not enough. Over the long term, it's not enough. So they need to, because they're not going to capture the entire market, right? Even if they get 5% of that market, right? Let's say they're working with 30 billion, 5% of that market is 1.5 billion, right? $1.5 billion is the revenue number, and right now they're at 500 million. So they can 3x the revenue over the long term, but that's only 5% of 30 billion, right? If the TAM was, let's say, 80 billion, if they can kind of dive into some of the other opportunities and some of the other, addressable markets, that opens up the door for them to generate more revenue and more possibilities for growth. So one of these three things need to happen, in my opinion, with the cash that they're sitting on: either buy back shares, issue a dividend, or look for opportunities to acquire other companies so that you can increase your total addressable market. Because, it's one thing having a lot of cash and no liabilities. That's actually fantastic, but it's another problem. It's actually a good problem to have, but the problem is that you need to do something with that cash, because just like us investing our cash, and we need to look for return on capital, it's the same with companies. They can't be sitting on all this cash when inflation's so high, and it's just losing purchasing power, right? Yes, they've invested that money, but at the end of the day, I would want them to look for opportunities that have the highest return on capital with that cash. So if you come over to valuation now, we're looking at 13 times earnings multiple. Even if you look at $200 million in a 2023 net income, as we calculated as an estimate, and they're sitting on $1.86 billion. So let's just do 200 divided by 1860 or 1864. We're looking at a 10.7% in earnings yield. And if you take that reciprocal, so 200, we're looking at a 9.3 times earnings multiple for this company, right? 9.3 earnings multiple. And then finally, if you come over to the cash flows, which also have grown, as you can see on an annual basis, they've gone from 37 million to now over $180 million. And even on a quarter-over-quarter basis, first quarter was a little bit lower, but they're back over $52 million, and trailing 12 months, we're sitting at about $169 million in free cash flow for the company. And valuation, like I said, under 5 times sales, 14 times cash flow, and a little bit over 8 times enterprise value to EBITDA. Excellent profitability margins, so return on assets, equity, invested capital, gross margins, operating margins, net margins. Everything is just over 30%, at least, if not 40, 50, some things even 80%, right? And we got liquidity ratio, current ratio is over 11. So, I mean, this is a company that has very little to no debt, no share dilution, growing revenues, great margins, great profitability. Cutting their guidance a little bit, but even despite that, they're expecting growth on a year-over-year basis for revenues and earnings. The couple concerns that I wanted to address again are the market itself, right? It's not that big of a market, so they need to look at opportunities how they can grow their market, their TAM basically, and then do something with the cash they have on the balance sheet, right? Acquire, pay out a dividend, or buy back your own stock. I mean, it's cheap right now. In my opinion, at least, it's cheap. So why not buy back your own stock? So that's my entire analysis on Inmode. Let me know your thoughts down in the comment section below. If you have any questions, feel free to reach out. Discord link's going to be down below if you're interested in joining. And as always, happy investing. I'll see you all in the next video.